Finacle Academy. It's truly a privilege to host you. Thank you so much for taking out time to speak to our students. To give everyone a bit of a background, we have been in touch with Manish sir professionally since 2018. It was the first time where we connected professionally, where a couple of our students, we had pitched to Manish sir, Manjeet sir for recruitment purpose. And since then we have been in touch. Manish sir has been very kind as a person to help us grow as an organization. His feedback has been very, very important to us through the entire process. To talk about his personality, he is a very open person as such, like very approachable. Honestly speaking, very responsive over the emails. Like I've never ever had a chance where Manish sir has not replied to any of our emails. So we are really lucky to be associated with such a professional. To speak of his professional achievements, Manish sir is an alumni of IIM Ahmedabad. He has worked in the industry for quite a long time and has spent more than 8 years with late Shri Rakeshji Jhunjhunwala, obviously the legendary investor. It's truly a privilege to host you, Manish sir, and he's presently CIO and founder of Solidarity Investments, which, by the way, happens to be a very reputed portfolio management company in the industry, not just known for the phenomenal returns, historically speaking, but also for their style of investing. The investor letters or memos are genuinely a tremendous source of wisdom to all of us, through which a lot of our students have read, and they have submitted a couple of questions which we have invited Manish sir to answer. Without any further ado, sir, very much welcome to our academy, and thank you so much for taking out time.
Thank you for the genuinely very warm welcome. My wife would faint if she heard this, but thank you. I really appreciate. I don't think all of this is deserved, but I appreciate your very warm welcome, and very happy to share my perspectives with your students.
Thank you so much, sir. And to keep the session interactive as well as fruitful for everyone who is either part of this session or watching this video, we have tried to keep it in a Q&A format. So the students whose questions are present here on the screen, they will be asking those questions to you, sir. And then we will await your words of wisdom on the same. So maybe, sir, we can start. And by the way, sir, we have Pratik as well in the session, who is the co-founder of Finacle Academy, which obviously we have interacted in the past.
Sure. I think we've met Pratik, right? We met in the past.
Yes, sir. I have met you twice, and Manjeet,
yeah, that's what I said. I've met Pratik before. Okay, let's start. Sharish, let's go.
All right. So, sir, the first question is from Shivik and Mihir. Both of them are our FinPlus students. Shivik, Mihir, maybe you can start with your question.
Yeah. Thank you for the opportunity, sir. So my first question is that I noticed that the part of the portfolio is focused towards capturing long-term trends, like increase in per capita income and hence consumption, increase in awareness of insurance and supply chain de-risking from China. And the past pattern of these themes is hard to find. So it's difficult to judge that how they're going to play out in Indian context. So I wanted to understand that how to differentiate between these long-term structural stories and fads or blips. And what are the data points or qualitative aspects which are most crucial to understand and to differentiate a structural trend from a cyclical one like we saw in COVID times, that API story and the middle cycle, which was supposed to be a super cycle, didn't play out like that. So that's my first question, sir.
Yeah, it's a curveball. First up, very interesting question. So what I heard you ask is, how do you separate what is a structural trend from a cyclical trend? Yeah, yes, that's a great question. So, you may be aware of what's happened in the US, and CEO after CEO, whether it is Mark Zuckerberg of Facebook, whether it is the Stripe CEO, I think everyone, and I think even us, we thought that digital is going to be really big after COVID. It's a permanent change. And what one has seen even in the US, that, for example, offline retailing, the online retailing, which spurted up post-COVID, the trend has now reverted back to what it was pre-COVID. So it's not easy, right, to figure out. So the way we look at it at Solidarity, we think that everything is cyclical actually, right? But you have something which is less cyclical than something else, right? So something, you will have companies that we call are very, very shallow cyclicals, right? So when we are betting on structural trends, right? And we actually are, as we speak, betting on 11 structural themes. And we don't know to what intensity will all of them play out, right? But you know, when you construct a portfolio, that diversification is a free lunch, right? So we would never construct a portfolio which has only 8 to 10 names, right? You would construct a portfolio of about 15 to 20 names. And in that, going in, at least we are comfortable with the notion that we will get a few of our calls wrong, right? Because what you thought is a structural is not as structural as one thought it might be, right? But we are also very, very clear that we will not bet on things that are clearly very cyclical. So for example, we find commodities very, very cyclical. And, we don't think we are competent enough to understand when the commodity cycle will turn, right? But we believe that there are certain things which should be fundamentally structural, that for example, everybody should need health insurance, right? The fact that the unorganized sector in most sectors in India is actually losing market share. The fact that the world needs to de-risk from China in terms of manufacturing because of geopolitics, right? So we believe all of these are structural themes. What we mean by structural themes is that you will not have degrowth in these themes. But you cannot predict the intensity of how the growth in each of these themes will play out, right? So one is betting on themes which, as Johnny Walker says, I'm a slow walker, but I don't walk backwards, right? So we are betting on themes where you know that the trend is in one direction, the trend is pretty unilateral, and you bet on 15 or 20 names across some themes. So some themes might not play out to the intensity with which you originally thought they would. So I don't know whether that answers the question.
Yeah, just a follow-up question on that, sir. So how do you build a position? For example, if you've identified a theme, so you are going to build a position like 10%, 20% within 6 months, 1 year, 2 years. So any thoughts around that, sir?
So, that's a more complicated response, because what we tend to do is, that's more the art of portfolio construction. So what you're looking for is to build a portfolio with a bunch of companies which are perhaps uncorrelated. So we will have domestic stories and we will have export stories, right? So hopefully they're not very, very correlated. Within export stories, you will have different sectors. So in our portfolio, we have chemicals as a theme, but we will also have other themes, so that So portfolio construction is more, again, you diversify across uncorrelated themes. Now, which theme to put more money in, which theme to put less money in, that becomes a little bit of where valuations are in each theme, right? So for example, a couple of years ago, valuations in banking were rich. A few months ago, valuations in banking were very reasonable. So we were fairly overweight banking. Just pre-COVID, we were fairly overweight specialty chemicals, right? So it's a question of it's a question not just of what growth opportunity that one is seeing, but what is the price that is embedded in that growth opportunity today? Because the entry price will affect what returns you're going to make. So there is no mathematical formula of I will put X% in this theme and I'll put Y% in another theme. That really depends on the price that one is paying, and one will act accordingly. And then, we do some numbers, and if something is very attractive, you will put more in the portfolio. If something is illiquid, you will put a lower weight in the portfolio because you want to be able to correct your errors if you're wrong. So that's a little bit of a more complicated answer. We won't be able to cover all of that in a short period of time.
Okay, thank you, sir. So my next question was, that in one of the letters, I noticed that you suggested taking 5% position of a personal wealth in gold. And I wanted to understand your thought process behind that allocation, or what major risk you are sensing, or how far that risk is. And is it due to constant currency depreciation or something else? And one of my colleagues wanted to add to it that what its solidarity current take on gold and volatile times like that. So it is I mean, are you going to thinking about taking 10 to 15% of the portfolio, or how you're thinking about that? So,
okay, again, very good question. So, we've had a bit of a rethink on our position in gold, and I'll explain to you why we had the position and why we've had a rethink. So, since 2014, we are an equity shop, but some of our clients will ask us about other asset classes, and then we give them our perspective on that. But since 2014, we have actually been worried by a lot of the money printing that has been happening in the developed world, right? And investing is actually a lot about pattern recognition. So you go back to historic time periods and ask yourself that if you believe that a lot of money printing creates inflation, what happened during very, very high inflationary periods? So we went back to the 70s, which was a very, very inflationary period. And what we found that gold did very, very well in that decade, right? Because, it kind of protects purchasing power. So we always told people that, listen, central bankers are printing a lot of money. It's not showing up in inflation, but at some point in time, it will show up in inflation. So why don't you put a little bit of portfolio in gold? Because if you have hyperinflation, then gold will act as a bit of a hedge. And, if you put 5%, you actually don't lose much opportunity cost. And if you have massive hyperinflation, which is gold going to $5,000, $10,000, that 5% will actually do very well and provide some cushion to the portfolio. So that was the original thought process. Now, what made us change our mind is that our original thought process was that gold is a hedge against inflation. Gold is a hedge against monetary disorder. Gold is a hedge against, geopolitical conflict. But when Russia invaded Ukraine, we had the perfect storm, right? You had geopolitical conflict. You had inflation going up dramatically all over the world, and yet gold did not move, right? So when I bring investing back to that, investing is pattern recognition, we had a view on gold precisely for the circumstances that exist today. Very, very high inflation, hedge against geopolitical conflict. But despite all of these things happening, gold did not move, right? At the same time, one was seeing very attractive opportunities as entry points in blue chips, right? So the question is that if we are long-term investors, how does one think about the fact that you could be wrong? I mean, at what point do you define that one is not losing patience? And at what point do you be humble and say, I think I've got this thing wrong? Because empirically, things are not moving per my hypothesis, right? And we came to that situation saying that, listen, we've held this for a long period of time. If it has to do well, then maybe 5% will not cut it. I need actually to have a 10 to 15% position for me to protect the portfolio if, I want to balance this against a collapse in equities. And if my hypothesis is not playing out empirically, and then do I double up and go to 10 or 15%? Or do I, say that maybe I'm wrong and I should invest the thing in a blue chip? At the same time, as an example, HDFC Bank was trading at almost, 1 standard deviation below mean and gave a very, very attractive entry point. So, all considered, we felt that, okay. And then again, when we went back and looked at the gold data, what we realized that gold has never done consistently well. It breaks out in short time periods and does well. And then again, it, does nothing for long periods of time. So we said, if we are willing to embrace that, if you're getting a blue chip at a very, very attractive valuation, but your thesis on gold is not playing out. Maybe, central bankers are wiser now because they have learned from monetary policy mistakes of the 70s. And one of the mistakes that was made in the 70s was that central bankers waited very, very long before raising rates. And this time, they are determined to crush inflation, even if it means collapsing economies into recession, right? So in our considered wisdom, we felt that the facts premised on the facts on which our gold hypothesis was premised is perhaps no longer valid. And therefore, we should change our mind. And that is what we've done. So as of now, we are not giving a recommendation to own gold.
Yeah, thank you, sir. Thank you for the explanation.
So moving to the next question. The next question is from Anisha. She's our FinPlus program student. Anisha.
Oh, yes, sir. Hello, sir. Sir,
Hi.
while reading some of your quarterly letters, I read about how you made an investment in Lupin despite aware of looming FDA regulatory issues. I have 3 questions lined up to that. First, as per your experiences, what are the key risks you analyze in the business?
So what are the key risks one analyzes in any business?
Yeah.
Okay. So that's, there's a laundry list there we look at. So, there's the obvious stuff that you would look at, right? So, a good way of analyzing a business is just to follow the money, as they say, just follow the financials, right? So you start with what can go wrong in revenue, right? So what can go wrong in revenue is there excessive product concentration? Is there excessive customer concentration? Is your revenue very linked to rent-seeking behavior? Then you go to the next line, which is gross margin, right? So what can go wrong? What can go wrong in margin? Are you very vulnerable to commodity price hikes? Are you an importer that is very vulnerable to rupee depreciation, right? So essentially, just follow the P&L line, follow the cash flow line, and ask yourself in each line what can go wrong. So that's the more obvious ones, right? But in a lot of businesses, I think one's got to be very, very careful about some of the qualitative aspects also. So, for example, we recently exited we've had 2 errors this year. So one is we had an error in an API company that we bought because we based our investment thesis on the premise that there was a merger between 2 API companies. And API requires scale, and we thought that you will get additional scale. There's the synergy of cross-sell. You can go with a bigger product basket to all of your customers. And essentially what happened is that the merger did not happen. The merger broke, right? So we acted on a premise and the premise just did not take place. So the risk was the event did not happen, right? We recently exited a company this week. Again, the mistake we made was that we felt that as you had a lot of industries concentrating in India, this particular industry would also see a lot more consolidation and hence margin would increase, right? But, we've now given it a couple of years and we are seeing that the margin is just not increasing because the industry is just too fragmented, right? So a lot of the risks you also will make are qualitative based on your assessment of the strength of a particular business model, right? Pharma, for example, is a very, very tough sector because there is no way an outsider sitting outside can assess what FDA risks exist, right? So, one can be very big picture and say, try and assess a company's culture. It's very hard to ascertain whether a company is following rules down to the letter which the FDA requires. So we actually have a checklist of risks that everyone has to go through, and the analyst who's working on a particular company has to ensure that they've thought through each of the risks that we've identified. And when we come up with something new, we just add it to that list. So it's a very exhaustive kind of checklist, but a simple way, like I said, is just follow the P&L balance sheet cash flow line and ask yourself on each entry, what can go wrong and whether you've thought through that. One side comment over here is that, you can never completely eliminate risk, right? You just have to figure out it's important to ask yourself what can go wrong, but it's also important to ask yourself what can go right, right? And is the price reflecting that nothing can go wrong, or is the price reflecting that the market believes everything can go wrong, right? So one is to identify the risk, but don't be in a notion where you're saying, I only want a company that has no risk. That's just not possible.
Yeah, thank you, sir. Second question, what according to you, you think you have the highest probability of the permanent destruction of wealth in a business?
It's a promoter who, I think the biggest destruction of wealth really comes from promoter greed, excessive greed, right? You load on your business with too much of debt. You're seeing a lot of these bankruptcies in the US right now. So to me, I think the permanent loss of capital comes from governance and debt, right? So for example, we have never bought into a company irrespective of valuations if there is a promoter history of poor governance. Because if somebody has a history of shafting minority shareholders, right, basic human character never changes. It's a question of time before, the same thing happens again. So we avoid governance. We also tend to avoid very indebted companies. So we use a red line of debt to EBITDA of 2.5, maximum 3, right? We will not invest in a company where the debt to EBITDA exceeds 3. Now, you sometimes miss out on a lot of great companies because of that. So we missed out on CG Power because CG Power had contingent liabilities. We just couldn't quantify what those contingent liabilities were. So we couldn't calculate what the debt to EBITDA was. So, but I think over the long term, that process has served us well because you miss out on some great opportunities like CG Power, but you also avoid big bloopers. So these are the two biggest ones for me. One is governance and one is excessive debt. The third one, I think, is poor capital allocation, but that will never result in permanent destruction of wealth. But the two biggest ones will always be governance and debt.
Okay. So third one is.
Yeah, I think third one is already covered.
Oh yeah.
Salish, can I ask just one follow-up question on the above part, permanent destruction of wealth?
Yeah, please go.
Yeah. Hi, Manish sir, Pratik this side.
Hi.
So sir, just I wanted to ask one follow-up question on the misallocation part. Sir, like every investor has a different definition of what he calls particularly as misallocation of capital. A lot of investors even get very jittery, even if the management is trying to expand into the adjacent segmental categories. They want someone to just develop a higher and higher market share in their own niche only. Sir, what, according to you, where do you get jittery when it comes to capital misallocation?
Yeah, it's a fantastic question. So, I think every investor has to form a process that works for them, right? So, for example, as a firm, Solidarity feels that there is massive, very, very poor capital allocation happening in the consumer durable space right now. Because people are just expanding into companies are expanding into sectors which are very, very hotly competed and you have no right to win, right? So typically you will see in any industry that the top 2 or 3 players have disproportionate share of the industry profit pool, right? 3 players. So now if you are entering a sector where there are already 5 or 6 strong players and you are entering as number 6 or number 7, how are you going to make money, right? Now, this has worked in the past because people have come in and they've displaced the unorganized sector and they've taken the unorganized sector's share. But if you are entering a sector which is hotly competed with 3 or 4 large players, then they're just not going to roll over and die and let you take market share, right? So for us, that a sector like this, as an example, is something where we believe that management teams will be better served either segmenting the market more intricately and aiming for more market share district by district, or just building up cash and waiting for an opportune time to do an acquisition. Because management teams typically will follow this by saying that, why should I earn cash at 7% when maybe my core capital, return on capital is 35%, and at least in this sector, I can deploy capital at 15%. Now, theoretically, that argument is not wrong. but you are making a huge leap of faith that you will be able to earn 15%, right? You are also, by deploying cash into a sector where you don't have any right to win, you're taking the optionality away from you, that a great opportunity might come where you could, take that cash and do something with it, right? So for us, that's an example of companies who are allocating poorly. We would prefer companies exploring adjacencies where you have a right to win, or in white space, right? We don't particularly like companies that are getting into adjacencies that are already hotly competed. Now, there's no one way to think about life, right? I mean, that's our view of the world, and it's worked well for us. And like I said, you have to follow a process, right? And if you get 8 out of your 10 calls right by following that process and not making errors, that's fine. Now, maybe a company does this and pulls a rabbit out of the hat and does very well. And then you look for, as I said before, it's all about pattern recognition, right? So you ask yourself that this company has done something that in our book is not the right strategy to follow, but yet they have come out trumps. So what exactly did they do that, helped them, achieve what seemed very counterintuitive? And then you put that into your process, right? So like I said, there is no one way, but that's our way about how we think about life, right? We would prefer companies focus on their core and not get into adjacent sectors which are already hotly competed, unless they believe they can displace incumbents and become number 1 or number 2, right? And, I don't think the track record on that is very, very high.
Absolutely, sir. Thank you so much, sir, for your point of view. Thank you so much.
Thank you so much, sir. Sir, the next question is from Dhruv Doshi. Dhruv?
Hello, sir. It's great to have you here. So my first question is, what are your views on startup companies? Recently, Zomato.
Dhruv, you're not audible. Your voice isn't audible.
Startup companies is out of syllabus. I don't want to talk about anything which is not in our circle of competence. So maybe you'll excuse me on that. Startup is out of syllabus.
Sure, sir. So, sir, I'll ask my next question for now. So, sir, how do you evaluate a company which is constantly growing on debt, and during such inflation period when the central banks of the world are increasing their rates? So, what are your views on such companies and the leverage that plays a part over it?
So, see, it's very difficult. See, okay, it's a great question. So, Indian companies have this great opportunity for China plus one, right? We all agree on that. Now, as a manufacturing company is not like a service company, right? You first need to put an asset into the ground. So, the fact that a company is taking on debt to grow is not a problem. I think that's a problem if your debt to EBITDA is going out of whack. So, if you are growing capex through debt, but your debt burden is under control, and if you can take on debt at whatever, 7% or 10% now, but your return on capital is 18%, what's the problem on taking on debt, right? The problem is if companies are taking on debt and not generating any operating cash flow, right? So for us, the metric is a company can be free cash flow negative. That's absolutely fine because you're investing for growth. But we do not like companies that are not operating cash flow positive. So if you're growing very quickly, but your working capital is out of control, I think that's a problem, right? Because if your working capital is very, very high, it just shows very poor terms of trade with your customers. So debt is not an issue as long as I said, our red line is debt of 2.5 to 3. Preference is debt to EBITDA of 2.5. And we see many great companies that we have owned where once the debt to EBITDA has gone at 2.5 or something because of the growth opportunity, the promoters have raised equity because you see a great growth opportunity ahead. You are not being greedy. You want your balance sheet under control, right? So we are not subscribers to this notion that don't dilute, let your debt. So we also don't like debt to equity as, we prefer debt to EBITDA because, equity can be revalued. Equity is past glory. EBITDA is best metric actually is debt to operating cash flow, right? You have to be able to have the cash flow to service the debt. But debt per se is not an issue if the debt to operating cash flow or debt to EBITDA is under control.
Got it. Thanks so much.
Thanks so much, sir. So the next question is from Ruchit, our FinPlus student. Ruchit.
Yeah. Good evening, sir. Thank you for having this session with us today. So my first question is regarding, like, it's on the softer skills aspect. Like, my first question is, how useful is behavioral finance, and how does one learn and practice it consistently?
I think it's all about behavioral finance, right? I don't think any of us will debate whether if we all get together in a room, there'll be no debate on whether TCS is a great company or Hindustan Lever is a great company or Nestle is a great company. There's no debate on that. The real question is, what is the price you're willing to pay, right? So a lot of this boils down to trying to understand who you are as a person. What is your time horizon, right? So if your time horizon is, say, 1 year, right? Trying to understand where the market is in the behavioral cycle is very, very important, right? Because if your time horizon is very, very short and the market or a sector is in decline or a sector is out of favor, you might as well toss a coin, right? The more you stretch time, if your time horizon is decadal, right, then where the sector is on the behavioral cycle matters less. What matters more is what the earnings growth is going to come and what your starting point is, right? But behavioral finance is very, very important. It's all about managing greed and fear, right? Because we keep getting stimulation from newspapers, our colleagues all the time. As a fund manager, if you're holding cash and the market is running up, it tends to create anxiety. So I think the whole game is behavioral. How do you have clarity on how you're wired? How do you get clarity on, you have to have clarity on what your time horizons are. You have to have absolute clarity on what you think is fair valuation and what is not fair value, where you will wait, where you will end. I would think that we need to spend a lot more time in finance education on not technical tools only, but also case studies of how people have got great companies wrong because they've misread the behavioral cycle or they've lost control of their behavior. We've made some mistakes where, you can call it fear of missing out or something. Some of our mistakes I would attribute purely to behavior, not analytical stuff, but to behavior, where in hindsight, if we are truly honest with us, we overpaid because of fear of missing out. That's all behavior, right? And you got to work on it all the time. So I can't stress the importance of that. And there's a great book written by the late Parag Parikh on that. It's a masterful book to read. You must read that on behavioral finance.
Thank you, sir. So my second question is, like, you must be reading a lot of stuff, a lot of newsletters, a lot of books, or a lot about companies. So how do you retain the information that you read? Like, is there any framework that you have?
Very, very good question. So, I keep a diary in which so again, there's lots of stuff you read. So some of the people I really love to read is, I like this guy, Naval Ravikant, a lot on just how to live a good life. And what I realize is that if I write down what I've read, it tends to stay. So one of the habits I have is that I have these two diaries, and I write down interesting stuff that I've read in them. And on flights, I tend to just flip through those all the time. So because I keep rereading some stuff that I've read, it will kind of then stay with me. So this is more on, philosophy, personal development, how to live a good life, that kind of stuff, right? As far as the investing thing is concerned, we are a very process-driven firm, right? And it's just not me. We have a team, and I encourage people in our team to write a lot, right? So when you write, it clarifies your own thought process and your thinking. And once you've written something down, it tends to kind of cements itself in your memory. So yeah, I think that's about it. But so we make fairly detailed investment notes. The investment notes will capture a framework. We publish some of our frameworks, right? So there's a behavioral cycle framework we use. We publish that. We have valuation frameworks we use. So I think writing stuff down tends to cement a lot of it for me. That works for me.
Thank you so much, sir. Yeah, that clarifies a lot of things. Yeah.
Thank you so much, sir. So the next question is from Yash Gandhi. He's our FinPlus program student. Yash.
Hi, Manish. Thank you again for your time. So my question basically is, in your FY18 Q4 letter, you had these differentiations like clear, emerging leaders, transformation, deep value, like some of the characteristics that you use to define stocks. How do you decide on capital allocation on that? I mean, sir, because there might be times where you may not get a lot of deep value opportunities, and there might be times where you might get many. How do you decide that?
Yeah, it's a fantastic question, Yash. So, Yash, I think the toughest part, I think, of being an investor is having clarity on how you're wired, right? So, I think so. So, for example, so if you look at the investing world, on the one hand, you've got Charlie Munger, who says at the right price, who says buy a great company at a broadly fair price, right? So think of that as our clear leader and emerging leader, right? On the other hand, you've got Howard Marks, who says at the right price, everything is AAA, right? So that's more transformation and deep value, right? In our book. Now, you got to figure out, there's this guy, John Galbraith. He has this quote. He says the sign of a first-rate intelligence is the ability to balance two opposing constructs and still function, right? I think it's a very powerful quote, but all of us tend to think we are smarter than we actually are, right? So just because Rakesh Jhunjhunwala could trade and invest, everybody thinks that they can trade and invest, right? The reality is, right, most people lose money trading. But, Rakesh Jhunjhunwala used to do it. So why can't I do it, right? So all of us have played gully cricket, but, we are not Sky. You can't hit the kind of shot Sky and Virat Kohli have been hitting. So I think a good starting point is understanding your competency. And what I've realized is that, deep value and all that doesn't really work for me, right? I won't get into why it doesn't work for me, but it does not. So I'm more towards the leadership style. Great companies pay a broadly fair price, right? But we can't, as an investor, I also believe one should not be rigid with ideology, right? Because as you very rightly said, what if you have a situation where all the great companies you want to buy are very, very expensively valued? So what do? Should you put capital in deep value or should you just sit on cash? So what we do is typically, and because I'm the CIO and fortunately or unfortunately, a lot of my beliefs are influencing how the firm invests. We keep about 85 to 90% of our portfolio in the leadership bucket. And we keep about 5 to 10% for transformation and deep value. But very clearly, the preference is to put 100% of it in leadership if we can. Because that's a style that works for me. You have to churn less. You don't have tax incidents. You have less reinvestment risk. You have lower chance of getting stuck with governance issues, right? It's, when a company is very deep value, typically it will be deep valued for some reason, right? And often the risks are not very evident. It's like an iceberg, right? So today, for example, we have something in our portfolio which is at 2 or 3 times cash flow. Very clearly, it's not something where I would say the promoter is very visionary or something, but it's very, very deep value. Now, the view we have taken, the considered view we have taken is that there is no governance issue in this company, right? The market is extrapolating a family conflict and all that, and the promoter is not a cheat. But at the back of my mind, right, it still always bothers me that what is it that I am seeing in a company that is 3 times cash flow? So but the nature of how I am wired, I will never have the courage to put 5% of the portfolio into a deep value stock like this because I'm managing money for other people. And I'm always concerned about what I'm missing. At the same time, I will have no hesitation in, say, putting 8 to 10% of the portfolio into, say, as we speak today, say a company like HDFC Bank, right? Because if I'm wrong on valuations, then I know I can add a little bit more because governance is not an issue. So you have, Morgan Housel. I advise a lot of you, I would advise all of you to read what Morgan Housel writes. And he says a lot of this debate and shouting between investors is essentially people disagreeing on time horizons. And I would add people disagreeing on your ability to, tolerate governance and, your ability to live with slightly higher valuation, right? I think long-term investing is an infinite game. Why do I have to optimize for 1 year or 3 years? Why can't I optimize for 20 years? If I'm optimizing for 20 years and I mildly pay 15% more for a great company, I mean, over 20 years, it hardly matters, right? So I think everyone has to be very clear on what is the game you're playing, which is what is the time horizon with which you're working, what is your tolerance to drawdown, what is your tolerance to quality of a business model, what is your tolerance to capital allocation risk, and you will find yourself constructing a portfolio basis these beliefs, right? Does that answer your question, Yash?
Yes, yes, Manish, very clear. And I just have one sort of related question.
Yes, but can I ask one follow-up question on your aspect?
Yes, yes. So
Yeah, Manish, sir, sorry to pitch in. I have one follow-up question on this allocation aspect.
Yeah.
So, sir, the thing that you explained, like, you would definitely love to have the highest allocations to the clear leaders, right? As an individual investor, I might also agree with that particular ideology. So, but I would like to, highlight few actual challenges that I particularly face, while I have a lot of clear leaders in the portfolio. As you said, there is a consistent fight in the brain between the reinvestment risk, the current allocation, and the maximum allocation that I can take. For example, if I am holding a stock because it was a clear leader, right, and valuations were decent, I went up and I loaded the portfolio with 10-12% at the current market price. And something wrong happened, which we can term it as a temporary issue, which might last for 4 to 6 to 7 quarters. Now, the dilemma that I particularly face here is what to do about the allocation, right? I cannot take advantage of the lower price because I am already at a very high allocation. I have an issue of the reinvestment risk that if I end up, coming out of the business right now, I would have to, buy 3 business to replace one, and it will become difficult to track. But at that point of time, I know that for the coming 1.5 to 2 years, I might be stuck at the current place only. And the problem is at such junctions, something happens, I don't know why, but value starts emerging in one or the another sector that, we might be tracking for a long period of time. So how do you manage such situations? Do you go with the pain? Do you rotate? Do you curtail some portion and you still hold 4-5%? What does practically, how do you handle it?
So there was a great question earlier, right, about what can create permanent erosion of wealth. So, and I'd answered governance and leverage, right? So for a fund manager, what you have to be very disciplined about as a fund manager and even personally is risk management, right? So, this is an infinite game, right? So it's not a game, like you said, that for 2 or 3 years, the stock might not do anything. I would encourage you to define what your own risk limits are. So, for example, we have our process is what? Our process is that, let's say we bought a stock where the debt to EBITDA was within control, but the company's done some, we have a situation right now actually, where we like a stock, we like a company, we think it's a good decadal story ahead. The company's done very aggressive CapEx, and now because of the war in Europe, customers have delayed their buying. As a result of which, you've taken on debt because of the CapEx, but your EBITDA has not grown, and therefore your debt to EBITDA now has crossed the ratio, right? Now, we are fairly disciplined. I like the story, but my debt to EBITDA has crossed my red line. What does that mean? I will not do any incremental buying, and I will not buy in new accounts, right? But this is not a business model issue, right? It's a temporary problem. You want to wait for the debt to EBITDA to come back, and you will then add to the position. Now, one should not be exceedingly rigid in such rules. This is our situation today. If the stock falls 20-30%, right, and we know it's temporary and we continue to believe it's temporary, we might take a little bit of a position, but not a big position, a little bit of a position. So we have certain rules, right? So if we have a clear leader which is debt-free, right, we think we will go up to 15% in the portfolio if an opportunity presents itself. If we have a company that has got leverage, for example, a bank is a fundamentally leveraged entity, we never cross 10% in a bank because, you never know what can go wrong in a bank, right? It's a fairly opaque entity. So we have put these risk limits for ourselves, right? I would encourage you to put certain rules for yourself. At times they might be very limiting, but you will prevent blow-ups as a portfolio manager. In the long term, if you survive, you will do well, right? So most fund houses blow up because people take disproportionate risks, which then blow up in their face, right? So in your specific situation, a learning for you might be that maybe I took 11 to 12 too soon as a position. And therefore, so what we do, again, in our clear leaders, which are typically well-run companies and are very, very liquid, we go up to 10% as a maximum position, but we would typically start with 6 or 8 and build up over time. In an emerging leader, our maximum position is 8%. We would typically start with 3 to 5 and then build up over time, right? And we typically will not buy more if the stock is falling because a company is not executing. We would like to buy more if a company is executing well and the stock is falling because the market is weak or something like that, right? So some of these, again, rules that we put in our process that work for us and we keep refining over time basis our learnings. Does that answer your question?
Yes, sir. It perfectly does. Thank you so much, sir, for sharing the framework. Okay. Thank you so much. Yeah. Yash, you can proceed with your next question.
Sure. Thank you, sir. So Manish, so basically just a quick comment on that. So would the capital allocation also depend on the size of the portfolio? I mean, if I speak for myself, I have a small portfolio and maybe 15-20 stocks is over diversifying my portfolio. So what are your comments on people who have small portfolios? Should they also then restrict stock which is doing well, not because they have put more money, but because it's outperforming compared to other stocks and it becomes a large part of your portfolio? What do you do in that sort of a situation?
See, Yash, the golden rule is that there are no rules, right? As an individual investor, you're not accountable to anyone, right? So, Rakesh Bhaiya had 35% of his portfolio in Titan, right? Now, I think a concentrated portfolio can work both ways. It can do very well for you, but if you've got the call wrong, it can do badly, right? So I don't know what rules you should set for yourself, but what I would encourage you to think about is that if you've got onto a great company, you understand the company well, the balance sheet is clean, you've thought through what can go wrong, and you want to hold a large position, why not, right? But if you are building a position basis ego, saying, I'm not wrong, you're buying on declines, and you build a long position, company's not executing, it has got debt, I think that's a recipe for disaster, right? So, Charlie Munger has portfolios with 4 or 5 stocks. I don't think Warren Buffett thinks like that, right? So it all boils down to understanding how you are wired. The most important thing is you need to have a strategy that you can stick with. So if you have a concentrated position and the portfolio is down 30%, right? You need to be able to stick with that, because what you don't want to do is cut your losses when you're 30% down, right? So you have to, there are no golden rules here. You have to set up the rules that work for you. My bias would be always to be a bit more diversified, especially when you're young, because you will never learn from others' mistakes, right? This is the age where you want to make mistakes because you're dealing with the smaller amount of capital. And those mistakes will help you define your process. So when you become, it's a bit like, say a cricketer is trying to audition for a team and you try and do a reverse sweep and you get out, right? It's curtains for your selection, right? So the younger you are, as they say, play more in the V, right? as you get older, you have more battle scars, you can take more concentration risk. So what I want to leave you behind is there are no golden rules, but I would avoid concentration the younger you are.
Okay. Thank you, sir. Very clear. Thank you. Appreciate it.
I see a question here. Can you please elaborate? Curse of the value investor is that they're always too early. So yeah, this is a great quote. By the way, it's not mine. I picked it up from somewhere. I don't know who said that. So the thing with the value investor is because, what I've seen with value investing is that a stock can be cheap and it can remain cheap for long periods of time. So a cheap stock typically needs a trigger for a re-rating to happen. Because if everyone can see and run their screens and see a stock is cheap, you've got to ask yourself, why is the stock cheap? There is a risk there which perhaps you have not seen. So the point of a value investor is that, you're buying onto something. So a growth investor is typically betting on growth and the fact that the derating might not be so sharp. A value investor is betting on both growth and a valuation re-rating. So the point was that typically a value investor comes in very, very early. And you can have long periods of time where the stock does nothing and the market is doing very, very well. So I think that was what the line was. That the curse of the value investor is that they're always too early, right? So
Okay.
that was the context, but it's not my line. I picked it up from somewhere.
Sure. Thank you for explanation. Yeah.
Thank you, sir. Next question, Mihir.
Good evening, sir. My name is Mihir. Sir, as you know, insurance awareness in India still remains low. So how do you see growth going forward? Could we see something like AMC having growth in regards to their SIP contribution? Previous month, we had 13,000 crore SIP contribution.
So I'm not sure I understood the question, Mayor. Are you asking me at what pace insurance will grow?
No. Mutual funds got their growth because people found value. Insurance also has value, but it's not getting that kind of recognition that mutual funds has got in recent 7 to 8 years.
Yeah, so I think it was this question, right, about something being structural, cyclical. The first question we started off with, today health insurance, private sector health insurance penetration in India is 4%, right? We are 1,400 million people, only 55 million have private health insurance, right? Now, I know that this is the trend, but I don't know whether it's this or it's this. So essentially, you're betting that the trend is like this, right? Now, what pace it will be, that's a fool's errand to try and guess what the trend is. Now, the AMC grew because they came up with this campaign of mutual funds sahi hai. So a lot of these sectors, it really depends on how aggressively participants get together and create more awareness about, where the sector is growing. I don't know what pace it will grow at. I mean, I have some numbers there, but those are intelligent assumptions. One could be totally wrong. But very clearly, if a sector has a need, and I think people need to insure their families against, their untoward death too early. People need to insure their families for health. A health incidence can put a simple middle-class family also into poverty. So all the conditions exist for the sector to grow. Now, what pace it will grow at, that's, very hard to call. So if one is patient and has long periods of time and the drivers are in favor, then the sector will grow. But, trying to put a mathematical number there is crazy.
Yeah. Thank you, sir.
Thank you, sir. The next question is from Paras. Paras, you there?
Hello, sir.
Hi, Paras.
Am I audible?
Yeah, can hear you.
Yes, sir. Thank you, sir, for your time. My question is, while leading a lot of con calls and annual reports, management gives out guidances that they'll do this, they'll do that. So sometimes they're aggressive in nature. So how to strike a balance between aggressive management guidances and the actual implementation of the guidance? Sometimes if we take position based on the management guidance, we might get wrong. But then if we don't, we miss out on early movements. So, sir, how do we strike a balance between both? Would you please guide us?
Yeah, I'm always suspicious of management teams that give a very aggressive guidance, because you got to ask yourself, why are you giving such an aggressive guidance? If I look at the best run companies in India, I don't see them, giving guidances. The world is so dynamic. So I am typically our firm is very suspicious of companies that give aggressive guidance, right? So the kind of guidance I would like is somebody who says, we believe over long periods of time, we should be able to grow roughly 15%, right? Somebody who says, I'm 500 crores today and I will get to 1500 crores in 5 years, that's very suspicious, right? So, you never know where somebody's stocking up their stock. Short answer is I'm very suspicious of, over long periods of time, it's very, very hard for a company to grow more than 15%. So typically when we think of companies and how we model growth, we will typically think 15 to 20. If a company is giving very, very strong guidance, right, you have to really ask yourself what's happening there. Trees don't grow to the sky. So we are always very cautious and worried when people come out with in fact, some of the companies that we've really liked when promoters have given very aggressive guidance, and these are companies whom we've held for a long period of time, we would actually mention to the promoters that they're doing themselves a disservice by giving that guidance, because you don't really benefit if the guidance works out, but if it does not, it's a credibility deficit.
So thank you for that amazing guidance. So my next question is, what is one of the worst investment decisions that you have made till now, and any learnings from that? If you could please share with us.
No, I never make mistakes. It's my team that makes mistakes. Okay. So, we've had 3 or 4 mistakes, big mistakes in our 8.5 years of existence, where we've lost 30 or 40%, right? And there's always something to learn. So, I think the worst mistake that I would say I made was Lupin. And the reason I say it was a mistake is because we had identified the issues, but, we changed our mind and did not back our own judgment, but we backed the judgment of other people around us. And we felt we are young, this was, I think, FY15, if I remember right. We felt we are just 1 or 2 years into fund management, and, we are probably not mature enough. So I think the big mistake was not backing our own judgment, right? I think that is unforgivable. Before you bet on somebody else, you've got to bet on your own self. And so we had written about how the Indian generic industry will come under pressure because of buyer consolidation. Our blog was on our website, and I think the Lupin price, if I remember, was 2,200 or 2,300 a share. And then the promoters started buying at 1,500. So, we said, are we missing something here, right? And, I think Lupin was a great company, one of the very well-run generic companies. And, so I won't go into a lot of detail. You'll find all our mistakes. We've written about them in our letters. But see, what's happened with the Indian cricket team right now, right? If you guys, we are all cricket fans, and my heart breaks, when we lose so badly. But, what you can see fear in their eyes, right? You can feel the guy is fearful he's going to get out. Don't be afraid of making mistakes, right? Which is why I was, telling somebody earlier that don't build too much of concentration in the portfolio. If you have a 4-stock portfolio and you make a big blooper, you will scar yourself for life. But if you have 20 positions and you have 5% in a stock, you are 30% down, you have a 1.5% hit on the portfolio. So, I'll make mistakes, you'll make mistakes. The question you should always ask is, what have I learned from that mistake, right? So during COVID, we went into COVID with a 20% position in ICICI Bank, right? And you know what happened to banks after COVID? Huge mistake. We had massive belief in ICICI Bank. Valuation was in favor. But, banks in the first month of COVID, nobody knew what was happening. So what was our big learning? And I think I talked about that a little earlier, that when you are dealing with leverage, you cannot take a massive overweight position in the portfolio. So we tend to cap banks at 10%, basis this learning. So if we are very, very excited about banking, we will cap a position in one bank at 10, and then we will buy a third bank, right? So we will buy a third position in a sector rather than take on massive concentration risk, right? One of the big mistakes I made was investing in a stock where the debt to EBITDA was 4.5, And it was premised on the belief, we talked about guidance a little earlier, that the promoter said, I've got this land, I will sell the land. And when I sell the land, my debt to EBITDA will come down. I was young and immature. I was drinking somebody else's Kool-Aid, right? So we are very clear now that the day we invest, the debt to EBITDA has to be less than 3, right? So every time you make a mistake, it goes into your process and you are smarter next time. The third thing is when you invest, I think the edges in investment are getting narrower and narrower, thinner and thinner, right? So you've got to be very conscious of the risks you're taking on. One thing I'm very, very conscious about is building a flat culture, right? So the youngest analyst on the team should be able to tell me, Manish, you're wrong here, or you're not seeing this angle. Because it's very easy to agree with what the boss is saying, right? So we've learned again from these mistakes in the past. I remember one of our analysts, he studied a stock, and that stock was up for discussion. And, you're building a firm, you're busy. And, the stock ran up 2x, or I think the stock ran up 5x. And I asked him, I said, you covered this stock. Why did you not, remind me constantly that this was up for discussion? And, so again, it was one of my big learnings that the analyst assumed that because he had sent me an email that the work was done, right? So the learning is that you have to be able to get the person who's done the work has the most knowledge on a position. The older you are, you have more battle scars. You think you have more wisdom and more intelligence. That's actually not true. What you just have is a whole boatload of experiences. But each person on your team understands 30 companies far better than you do. So again, learning is how do you build a flat culture? How do you build an organization where people are not free to speak out and call out your bullshit? All learnings that come from experience. So if I keep telling you more of this, then, you guys will leak it out and I won't get new customers. So I'm going to stop here on my mistakes.
Thank you, sir. Thank you so much. It was amazing.
Thank you so much, sir. Thank you so much, sir, for the wonderful answer. So now, what we had quite a lot of questions from remaining students, but we understood that some of them were somewhere or the other integrated towards the same theme or the concept. So what we did is we tried to frame a comprehensive question around those concepts, covering and without letting multiple people re-hit the same concept again and again. What we did, we clubbed those questions across in a single comprehensive session, and which Prateek will, ask those questions on behalf of those multiple students who are attending the session. So Prateek, over to you.
Okay. Hi, sir. So, sir, first of all, because you have, written a lot of in-depth thing on the banking side in your quarterly letters, right? So basically, I would be blunt, students want to understand banking. Okay, how do you go about, picking a banking stock? Because if you see the questions, right, they have actually
I'm not getting good audio from your side.
Am I audible, sir, now?
No, I was getting bad audio. You have to repeat what you said.
Just is it okay now?
Yeah.
Yeah. So what basically they have done is that they have, jotted down the points from your annual letters, and they wanted to understand how you do it practically. So for example, like you wrote that it's very important to analyze the operating culture and the risk management culture of the bank in Q2 FY18, Q4 FY18, and Q2 FY19 letter. So their main question here is like internal managers won't meet them. So not from a CIO's perspective who has a huge network in the market, as a young analyst, how can they judge this particular aspect of operating culture going on in a bank?
Yeah, it's good. It's a great question. So I don't think I wrote it from this perspective. So I'll tell you how we think about banking or any business. See, in any business, there are typical 3 or 4 variables that matter, right? In any business, you have to nail down what are the 3 or 4 most important variables. So what's it in banking? So we think banking is a commodity business, right? You might love your relationship manager or your banker, but if you're taking a loan, you will go with somebody who's offering you the lowest rate, right? So if banking is commodity, what we know in a commodity business is the lowest cost wins, right? So what is the highest cost in a bank? It's your cost of deposits, right? So a bank has, so we essentially think that you fundamentally in banking, you will have what is called the, I'll talk about this a little later. So if there are 4 variables, what are the most important variables? First is you have to have the lowest cost position. The second is you have to have a fundamentally conservative culture, right? The third thing is you cannot be growing very, very fast, right? Now, a lot of this you don't have to figure out or meet junior people in the team to figure it out. Banking also is by definition, banking is fragile, right? When your debt to equity is 10:1, you are very, very fragile, right? So one of the things that we have said is that we will not target that part of the banking pyramid which is more fragile than other part of the pyramids, right? So we have never owned microfinance, right? Because microfinance is more exposed to political risk of a state government. You are dealing with a segment which is lowest in the income strata. So any stress on the economy is amplified there, right? So essentially what we will look for is public market data and how CEOs behave, right? Now, you can just look at the history of banking and see that other than Kotak and HDFC Bank, right? Everybody else has blown up at some point in time. So what is also important in banking is how the owner thinks, right? How Aditya Puri thinks, how Uday Kotak thinks, right? So you have to fundamentally, therefore, boil it down to who's got the lowest cost position, how conservative is somebody in how they think. A good sign of how conservative somebody is in how they think is how aggressively they provision, right, for their bad debts. Another good data point is to just look at history, right? The past history, basic human character does not change. Past history is a good reflection of an organization's culture for the future. Now, obviously, things have changed a lot in banking in India, but a good point was the RBI report, which came out on how RBI assessed what your NPAs were vis-a-vis what banks reported. So any bank which had huge deviations in those NPA reportings, again, is not really a management team you can trust. So in financial institutions, I think the single most important thing, other than your cost of deposits and your operating costs, is really, who's the leader of the bank, right? You are essentially betting on, in most businesses, leadership matters, but leadership matters more than anything else in banking. So you have to be fundamentally aligned with how the leader thinks, right? If a leader is very, very aggressive in banking, you're going to get massive growth, but you're also increasing probability of a blow up, because in banking, you have what we call an impossible trinity. You cannot have high growth, high margin, and low NPA. It's just not possible, right? The higher your cost of deposits, the lower your ability to price risk most conservatively. Because if you've got high price of deposits, you can never have the best loan rates. So by definition, you will pursue a segment which is more risky than the most pristine segment. And therefore, if you are growing very quickly and your deposit structure is not right, it's a matter of time where a blow up will happen, right? So we are very comfortable with the notion that if we invest in a bank which is lowest cost deposit, perhaps more valued, more richly valued than an NBFC, it is possible that over a 5-year term period, you might make a lower return than investing in an NBFC that's growing faster. I'm very comfortable with that notion, because the goal is that you don't want to lose capital. You don't want to have blow-ups, right? And history has taught us in Indian banking that the moment you load on risk, it's a question of time before you blow up. Right? So slightly long-winded answer, but it's not too complicated. You don't have to meet people to figure this out. You can just figure it out basis management commentary, reports on NPA recognition, what people's CASA ratios are, what people's cost of deposits are, what pace they are growing. You just read transcripts and all, you'll be able to easily differentiate banks and put them in different categories.
Okay. I think, sir, this also answers this question on the valuation front. that why the Indian markets value deposit franchisees rather than lending operations?
Yes, because I don't think there is any moat in credit, right? The moat. See, a bank is weird. A bank makes money on both sides of its balance sheet. So you raise deposits and you transfer price it to the treasury, and the treasury and the credit function will borrow money from the treasury. So you're making money on both sides. So our belief is that the principal moat in banking is really your ability to is your deposit franchise, right? If you can just be a credit institution raising money from the treasury and doing wholesale credit and all that, right? So we don't think that, today if you're looking for a loan, right, high probability you will talk to 3 banks. Whoever gives you the lowest rate, you go with them. But if you've got a bank next to your house, or the first job you worked with, if a salary account got opened, high probability you will still be sticking with that bank, right? So behaviorally, people don't switch banks even if some other bank is offering a slightly higher deposit rate, because deposit is more about convenience. So we think the principal moat lies on the deposit franchise. That's how we think is a firm.
I think you explained it perfectly well. So just one angle that I think that remains in the entire banking basket is, so students wanted to understand that you have, mentioned in your, quarterly letters that it's important to analyze loan book at a granular level, rather than just, absolute sectoral exposures that a bank have. So they wanted to understand, like, what kind of granular details do you personally like to see in the loan book to come to that judgment whether the loan book is a bit on the healthier side or not, both on the corporate front and the retail front?
Yeah, sorry. Okay, great. So, what we meant by a granular book is, see, the more corporate you are, right, the more your loan book is skewed towards the corporate side, 2 things will happen. So let's say your loan book is very, very heavily skewed towards AAA corporates. They're going to make no margin on that, right? A AAA corporate has 5 banks lining up their door, just waiting for a chance to get in, right? So if your book is very, very heavily skewed towards AAA corporates, high probability you're not making any margin on that. Now, if your book is skewed towards lower rated corporates, you're loading on risk, right? And on the corporate book, when you're loading on risk, each loan can make a difference, right? So what we believe is that if you have more of a retail-oriented book, a retail customer doesn't have so much of purchasing power, right? And if you've got scale as a bank, then you can amortize that costs far more. So typically you will see the smaller the banks, higher their exposure to corporates. Larger the banks, the books will be more balanced. So our preference always is for a retail bank, because you are spreading out the risk far more, far wider. You don't have lower margin on the corporate side. And obviously, if you have scale, then you can be profitable in retail. If you don't have scale, you cannot be profitable in retail. So that's what we meant by granular book, more retail oriented book rather than large corporate book.
Okay. All right. Good. And so just one last angle on the banking side. So you wrote a very, great angle in Q2 FY19 regarding how, banks and NBFCs parking service used to work in the 2017 period, which led them to report, much, much lower NPAs, the major off-balance sheet liabilities, and how they used to fund bank, money to the customer and get it back. So, I actually answered it to students who submitted a question. According to me, it's difficult to detect that. But sir, still they wanted you to ask, how do you come to such conclusions whether, something fishy might be going on regarding NPAs?
So, tricky question to answer. So
if you want, I can switch off the recording.
No. No, that's fine. I'm not going to take names. So the way it works is that, so I'm not saying everybody does that, right? I'm just explaining what was happening. And I knew this was happening then. And some banks got into trouble because of that, right? So what happens is that most NBFCs believe that they can price risk. So what is an NBFC? Typically, I'm excluding Bajaj and HDFC. But typically NBFCs in urban, who are dealing in urban markets will have a higher cost of finance vis-a-vis a bank. So when an NBFC is lending to people, you're also borrowing from a bank. Now, let's say you are bank A, there is an NBFC that you lend to, and now one of your corporate customers is in trouble, right? And that corporate customer has to pay you something, but he is in trouble. So what will you do? You will lend money to an NBFC whom you already works with. That NBFC will lend money to the company, and that company will pay you back that loan. And you have a soft understanding with that NBFC that I will do an adjustment with you over here, right? Now, this is very, very hard to detect, or it was very hard to detect earlier. Now, RBI has got very smart on this, and the auditors have got very smart in this, in trying to detect it. But these are kind of, things that workarounds that people can do. So this was what I mentioned as what was happening as the parking service or the round tripping service that people were doing. And the RBI has got very smart in detecting that. Right. So again, it boils down to in financial institutions, not just in banking. In most financial institutions, if there is only one variable that you have to look at, whether it's a bank, it's an insurance company, it's an asset management company. If you've got one variable to look at, you look at who's running the shop, who's the leader, and you have to find a way of analyzing how that person thinks. If he's tikram, as they say, you're in trouble, right? Because over time, your super smartness will result in some things that you should not be doing, right? So this is exactly what was happening. The round tripping this is exactly what was happening why some of the big banks went down.
Oh, excellent, sir. Thank you so much for, openly sharing, sir. Second, sir, the question by the group of students was, because you have consistently emphasized on the importance of asset allocation, the students actually, got together to decide, okay, let's get a hypothetical scenario of where we usually are. And we would like to Manish sir how he would like to structure such a candidate's asset. That my age is 22, 23. Our parents are self-sufficient, right? We own a 2 BHK kind of house in tier 2. Parents will keep on continuing for 10, 15 years. Parents have Mediclaim, LIC. One sibling whose marriage might come. And the main aim is to build wealth and take care of my own marriage and build a bigger home, bigger car. And my current CPC might be around 9 lakh, 8 lakh per annum. And I am from finance background, so I know कि 10-15% का drop per annum आता है and 40% का in a decade आ सकता है. How would you recommend such a guy? Because they wrote that this is actual scenario. If you average all of us out, so how would Manish sir go about the asset allocation here?
Asset allocation is actually a very, very personal thing, right? And it's a very personal thing. A lot of it is behavioral. I think in asset allocation, what I've observed is people ask you to introspect of what's your tolerance to draw down. I think the reality is that the tolerance to draw down really depends on the situation at that point in time. Book cricket is very different from playing cricket out in the middle, right? And what the reality is, in a rising market, we all want to take on risk. In a falling market, we all, wish we had not taken on that kind of risk. So I think the most important thing in everything you put over here is the drawdown in equity, right? And the drawdown in equity has to be experienced before you say, I can take that drawdown, right? So let's assume a scenario where somebody says that I have taken this drawdown before, I understand it. The simple rule that I would follow, at least what I do, so I don't want to talk about what I do for myself because that's not very representative. The simple thumb rule I would recommend is if you have deep tolerance for drawdowns, right? And if your parents are not dependent on you, right? Put 1 year, put 2 years of 1 to 2 years of emergency money in a liquid fund or in a fixed deposit, right? The balance you can put in equity. Because the way India is growing right now, you have to believe that corporate India will grow earnings at about 25% in aggregate, at least for the next 2 years. So in aggregate, so let's say 12% 1 year, 12% the next year, right? For you to lose capital over the next 2 years, multiples have to drop by 25% and you still break even, right? So you have tolerance to draw down, keep 1 or 2 years, maybe preferably 2 years of emergency money in an FD, and the balance you can put in equities, right? I would not recommend at this age illiquid asset classes. I would not recommend gold because, you know, at this age, you want to put more money underlying compounding. But the most important thing is that if you have put money in equity, no, don't take that out of equity. Take the drawdown. You know, don't try and protect the drawdown. Take the drawdown. You know, use the drawdown. If, you know, you've put 2 years of cash flow in and you get a 20% drawdown and, you know, you have a secure job, you feel comfortable of how you're doing in your career, knock a little bit of that money out, the 2 years cash flow, put 3 months into the market if you've had a 20% drawdown. Important thing is you have to believe in India's growth story. If you believe in India's growth story that earnings can grow at 12 to 15%, you have to take more aggressive positions in equity, take positions in well-run companies. Don't try and hit sixers. Don't do 3 to 4 stock portfolios. Make sure that you are investing. The younger you are, you know, there is always that temptation to, you know, because I'm so young, I don't have capital, I have to trade. You know, it doesn't work. Buy well-run companies. The power of 15 to 18% compounding over long periods of time is insane. You know, if you try and buy more risky stuff, for every 2 companies that work for you, 3 companies will not. You will essentially come down to buying good companies and that 15 to 18%. Right? Does that answer the question?
Perfectly, sir. It does. Thank you so much, sir. So the next question was broadly around the valuation side. Because this has been consistently mentioned everywhere. It is bit quantitative in aspects, sir. So please, you know, allow us that liberty. That everyone has, you know, consistently said that, you know, longer term interest rates impact cost of capital and hence are key to valuations. That is why growth stocks are falling everywhere. But when students went down and started drilling, that in the end, the cost of capital is risk-free rate plus beta into RM minus RF. They also know it is opportunity cost of capital, but let's stick to the mathematical aspect once. So on the one side, bullish RF is increasing. Bullish on the other side, the equity risk premiums are decreasing. So it cannot be just the effect of RF. There might be some unhidden connection between the RF and the equity risk premiums that affects the cost of capital. But it may be the behavioral nature or opportunity cost. कि अब तो FD में इतना बन रहा है तो equity में क्यों पैसा लगे? So they really wanted to understand the underlying ecosystem of the bond yields and the effect on equity valuations.
You know, this is a fantastic question and something that we have grappled with over long periods of time, right? We've really grappled with this. And I'll tell you how practically we have resolved this. So I see some reports from sell side sometimes, and I see people have discounted companies at 10.5%. And when we have studied the markets over long periods of time, we find that if we look at markets peak to peak, trough to trough, the Nifty TRI has done about 11%. So for the life of me, if for long periods of time, my index has done 11%, why would I invest in a company and use a cost of capital less than 11? Because that is what I will earn if I hold that company to maturity, assuming I buy it at the price at which that model is throwing, right? So, you know, we don't want to be excessively mathematical in how we think, right? So the way we look at life very broadly is that 11% is what the cost of equity is for India, what the index has done over long periods of time. And it also kind of matches out as 7.5% is typically what you make on the GSEC very long term, and add, you know, some risk premium to that. And we think that, you know, the fees that we should make should be at least, you know, between 1 to 1.5%. So in our models, we don't want to be excessively mathematical. If we really like a company, you know, fantastic company, debt-free, you know, XYZ, then we will never, ever discount it at less than 11%. In fact, you know, we would never discount anything less than 12%, right? Then if a company is not pristine quality, it is more like an emerging leader, we will add a little bit to that, right? So 12 might become 13, right? And the other way we do it is that while you will use a 13% discount rate instead of 12, our entry ask is also much higher than for a pristine quality company. So you are putting a double layer of safety. But, we think this ERP, trying to calculate all this, I don't know who sets the rules over here. So, we wrestled with this for a while, but we've not found it very useful. So essentially, we tend to stick with 12 to 13. When markets are getting very, very frothy, we will tend to veer more towards 12.5, 13. When markets are getting very depressive, we will veer more towards, 12, 12.5, right? Because mean reversion is
Got
low.
it.
So that's how we think about it. I will not have, I really don't know how the professors do it and come up with an ERP and all that. We just think that nobody thinks like that practically,
Correct. Correct, sir. Absolutely perfect answer. Thank you so much, sir, for this point of view. Really appreciate it. Sir, there was this one very important line that you mentioned again in your quarterly letters, that a long-term investor tilted more on business performance versus market gyrations. So here the students had two aspects, right? So they could come to that essence that Solidarity and you personally are more tilted on the business performance side rather than market gyrations, right?
Yeah.
The stock may go up and down for no reason. And they also read, one more line that in your annual letter only, that still it requires constant revaluation, right? Significant declines below purchase price merit introspection. So they just wanted to understand the gelling of both the mindsets, that we should focus more on the business performance side, but still the price should be respected in some angle. So they wanted to understand that what signals in price movement or volume movements actually help you understand and size your position better, especially at the point of drawdowns.
Yeah, again, fantastic question. So firstly, this point on business performance, I'll refer you to the, interesting exchange we had earlier, where I said, you got to choose how you invest, right? So if you're a deep value investor, you might think a bit differently. I like to think from a ownership mindset. So if I'm thinking from an ownership mindset, typically we say we are allocators of capital. In businesses, we want to own permanently. That's most of our portfolio. So the business performance matters. So I think a very tricky thing is that when a stock price is declining, it could decline for 2 or 3 reasons. One is a simple reason, stuff like COVID happens, the whole market is sold off, right? A stock could also decline because a company has come up with a weak quarter and there is some momentum stuff and people want to dump something that has not performed well and buy something that is doing well, right? Now, what we tend to look for is a company where the operating performance is strong and a company's had a weak quarter because of factors beyond its control, right? So it could be a company's had a bad quarter because if you take a practical example right now, the Russia-Ukraine war has resulted in commodities going completely out of whack. So if you think about China plus one, you could have a company that is actually gaining market share, a company that is signing up new customers, but is delivering very poor financial performance because it's got impacted by commodity prices, which will only get passed on with a lag. Now, that's a great position to be in because you know that at some point in time when the war gets over and the recession kind of wears off, what will happen is all the operating performance that you have done will start translating into revenue and your dislocation of margin because of commodities will reverse, right? But you've got to be very true and honest that it is not that a company is not performing and you are 20% down and you're saying, let me average down. I think that's a recipe for disaster. And we've made that mistake in the past. In fact, we made that same mistake in Solara, which we sold and we wrote about it. That we bought it at a certain price. We bought it premised of the merger. The stock fell down. We felt this is all inventory correction. And then the merger collapsed. So and then the stock price went even lower. So the mistake we made was we kept buying on declines when the core investment thesis premised on which we have bought had not yet played out. The merger had not happened, right? So this is something that I think requires, so we believe that long term, it's just not important to track the financial metrics that companies report. It's more important or equally important to track how is the company progressing on operating metrics, because the operating metrics will deliver the financial metrics over time. Financial metrics can keep doing well even though the operating performance is slipping, right? So therefore, as they say, don't add to a losing position. We will say add to a losing position if the operating metrics are improved.
Excellent. Thank you so much, sir. Again, a brilliant to the point insight. Thank you, sir. Sir, and sir, I'm really sorry. I'm not aware of your time limit.
What's the time right now? I'm not wearing my watch right now.
It's 7:30. Can I go on for 5-10
How much more time do we need? How much more time do we need?
Sir, how much you can provide? There are a few.
Oh my God, how many more questions do you get?
Sir, I can ask just the best 2 or 3 more, if that's okay.
Yeah, maybe another 10 minutes. Will that be fine?
Yeah, that would be excellent, sir. Thank you so much, sir.
Otherwise, you can just send them in by email and, we'll send a reply to you.
Sure, sir. So, sir, I think this is the most important question that I have seen. And I will have to, do screen a bit smaller. That students figure out the usage of this 2 diagram a lot in the quarterly letters. And they inform me that on one place, sir is explaining the market valuation cycle. On the second, he is explaining the capital cycle. But we want to understand the intersection of both. As per Manish sir's experience, how does capital cycle moves the valuation cycle, so that we come to a practitioner's point of view.
Okay, so we've seen the capital cycle. Typically, the two are linked, right? So the most important thing is the two are linked, right? So let's take a classical example of what happened to NBFCs just pre-ILFS, right? Now, I'm sure you explained to your students that in any financial institution, what is very, very important is asset liability mismatch, right? So I would encourage all your students to go back and look at NBFC balance sheets in 2018 and the wide mismatches in asset allocation that were happening, right? Now, even you were having a wide asset allocation, so risk was getting thrown out of the window. Asset allocation was not matched. But you look at the valuations in which companies were trading, right? So typically what happens in markets is that everything is pro-cyclical because of greed and fear, right? When things are doing well, it's very hard to take money off the table. And therefore, those excesses just keep getting amplified, right? Now, what the capital cycle shows you exactly what happened there, right? So, in fact, we've written about this in a fair bit of detail in our 2018 letter after ILFS, that you had a boatload of money that came into housing finance in 2017, private equity funded, right? So what happened is that because everyone was making money over fist and developer loans against property, a lot of private equity came into that sector. And as, a lot of competition, came into that sector, the first thing always is for stock prices to go up, right? Because, when there is a lot of growth that's happening, the stock prices go up, right? That growth attracts new competitors. And what happens is as the growth attracts new competitors, margins start to compress. When margins start to compress, the smart people will slow down growth, but the not smart people will load on more risk, right? You will start going into riskier and riskier segments. So people will start increasing the size of their developer book. People will start increasing loans against property, right? Then what happens is that then you have an event like what happened in ILFS. When you have an event like ILFS, there's a complete risk-off behavior, right? When you have a complete risk-off behavior, the wholesale people in NBFCs don't get any more funding. And therefore, what happens is that the whole industry starts consolidating again because now nobody wants to give you capital. Even private equity will not give you capital when things are not good. And therefore, the whole cycle starts again. And when everything collapses, you have people exiting the industry. So think about how many people have exited the developer finance market completely, right? And one's got to map that with the behavioral cycle. So what you see in that cycle there is exactly how things would have happened in NBFCs, where I don't know where NBFCs started. I think around 2014, most NBFCs were trading at one-time book, right? My dates might be a bit off. So when you are trading at one-time book, essentially what the market is saying is that you are only worth the capital that is sitting there. There is no value for growth, right? So you're essentially trading at despair. And then as growth starts coming in, it moves into early believer, takeoff, moves into euphoria, where you start getting traded at 3-4 times book. And then we call what we say is the music stops, which is now no one's giving you any more money lending in the wholesale market. And then the collapse starts. And the wholesale funded NBFCs would have collapsed the hardest. So some large wholesale funded NBFCs are still in trouble. Literally 4 years after ILFS is gone, some companies are still in trouble and still trying to work out their NPAs, right? You can just know who all these wholesale NBFCs are. So essentially, I'm saying the two have to be seen in tandem. And the riskiest moment is when everyone is doing well, when everybody will not be doing well, right? So when you see an industry, everyone in the industry making a lot of money and valuations being very, very high, as they say, that's the most dangerous moment, where you've got to be very careful about the music stopping and just not being able to get out. So I don't know whether that answers the question.
Okay. So it actually does brilliant.
And you see the same cycle playing out in different sectors, right?
Thank you so much.
You've seen the same cycle playing out even in specialty chemical, right? You have seen this cycle playing out in telecom as well, right?
Telecom.
Telecom, you had a situation where there was a time where Bharti was trading at a certain price where people felt that Bharti is going to roll over, right? So it was trading on despair. Now Bharti is somewhere between, we've changed the thing takeoff. Now we call it consensus. Now Bharti is a consensus buy, right? Everyone wants to buy Bharti because people believe now there is an upside that if Vodafone rolls over, there'll be further upside. But this is how you make money. You come in early. Now, again, when I said the curse of the value investor is that that you can be too early, you could be in despair and a stock can stay in despair for a long period of time, right? So what our strategy is that we try and plot where our portfolio is on this dimension, and you would try and have most of the portfolio in what we call the takeoff or what we now call consensus or the early believer stage. You will have a little bit in euphoria, you will have a little bit in despair, but most of the portfolio, we would like to have it in consensus or the early believer stage.
Got it. Perfect, sir. Thank you so much again, sir, for such a detailed answer. Am I audible, sir?
Yeah, I can hear you.
Yeah, time for the question. So I will come on to just, the most crucial one that I think, according to me, every student should hear. And so this is something that I genuinely want them to listen very carefully. Sir, any one crucial life-changing advice that you ever got and you would like to share it with the young students and us?
Oh, that's a tough one. Well, I don't know whether it's advice, but I have I think some things in life that have been life-changing. I think the first one is I went to Vipassana, and I think meditation has been something in my life that has made a huge difference. I would very strongly encourage all of you to try and practice that, right? The second thing I would encourage you is to read a lot. All of the world's problems have been solved. The answers are already in books. You just have to go and pull it out. Read as much as you can. The third thing I would say is that, I don't like this word role models. Just try and be a better version of your own self. What the world rewards is authenticity. The world needs you to be people like to deal with people who are authentic, right? So you have to stop apologizing for, don't be in situations where you have to do things which don't come to you naturally, right? You have to really understand how you are wired as a person. What are your strengths, right? What are things you are good at? And be in positions, be in careers that optimize what your strengths are, right? If you are an introvert, right, you don't have to apologize for not hanging out with people. If you need that space just to get your energy, it's absolutely fine. And I wish that, these were some things that I knew when I was your age, right? Don't waste your time working for a boss that you don't respect. Don't just change your career because someone's paying you more money, right? Avoid social media as much as you can. You really don't need a boatload of friends. What you need is 4 or 5 people whom you are willing to run through fire for, right? You need 4 or 5 people in your life where you say, I'm willing to run through fire for this person. And you can just hope that that person will do the same for you, right? So, it's a great life. And if you meditate, you read, you have a few close friends, you are working in careers that optimize your strengths, right? I think, you'll have very good careers. Last one, I think, is learn how to sell, right? We are selling all our life, right? When I was your age, I would hesitate from doing it. But, selling is a very derogatory word. What you're doing is you're essentially building trust. If you are giving to your customers in whichever field you're in, acting in their best interests, right? You will just see people just going out of their way to help you. So you have to be early in your and nothing teaches rejection like sale, right? Now, what's the beauty of it? Everyone needs to buy, but nobody likes being sold to, right? So it's a skill that you can develop very early in your life. And it's very, very important when you're young to go out, meet people, try and understand what they're looking for, solve a problem for them. This skill, the earlier you acquire in life, the more it'll help you. And it'll help you not just in your professional setting. It'll help you in life when you deal with your kids, when you deal with your family. Essentially what you're doing is you're learning how to build trust with people and understanding their perspective and getting them to understand yours. So I better stop now, Shailesh. Otherwise, this life advice is a very dangerous thing to ask a 50-year-old person. So,
Sir, I am at loss of words, sir. Thank you so much for being so candid and actually giving such an advice. I hope everyone would have benefited. I have personally jotted down all the points. And sir, we are again actually truly humbled that you have provided us such a long time, and to our students. It was our honor and our pleasure, sir, to host you today. I just wish, sir, sometime again in the future, our students can get the opportunity. And really, sir, from the core of our heart, thank you so much for coming today.
Sure. I hope it was useful. My wife just can't understand why you would have had me on your call, but I hope it was useful. And, if there are any unanswered questions, just email them to me. I'll try and reply via email. Thanks so much. I enjoyed the session. Thank you so much.
Thank you so much.
Thank you so much. Okay. Thank you. Bye-bye, sir. A very good night, sir. Thank you. Yes, guys, even you can exit. Thank you for being so patient. And I hope this would have helped you. अच्छे से हमने notes बनाए होंगे.